This is Jeff Krumpelman. I'm the Chief Investment Strategist with Mariner Wealth Advisors. And given the volatility in the market that we've seen, just thought that it might be a good idea to have a chat and discuss with you our take on these market events that we've seen over the last couple of weeks. It's been a roller coaster ride that we've been on the past couple of weeks in equities, and so hopefully this personal message will help. Last week, we saw the Dow swing 1,000 points or more in either direction on consecutive days throughout the week, and yet we eked out a modest gain for that period when all that head-spinning action was said and done. And then today, Monday, March the 9th, the markets opened up down more than 7% with circuit breakers employed to calm trading. And from the peak on February the 19th, the S&P 500 is off roughly 18.5% at this recording and in firm correction territory. Yet, we remain well above the December 18th lows on December the 24th, 2018. So what's our take on all of this? In a phrase like previous panic attacks surrounding such issues in this long bull market advance, such as the Arab Spring in 2011, the fiscal cliff in 2012, Brexit, and the ugly 2016 presidential campaign during that year, and more recently, the tense trade negotiations in 2018, we believe folks are jumping to worst-case outcomes and that we're witnessing a temporary overreaction to the coronavirus challenges. While we think it's too early to quote-unquote buy on the dips, which is that oft-used phrase during these previous panic attacks, we do believe that poise and perspective is critical to employ at this time, and we do believe that we're close to the bottom. Based on the data at hand, we believe the economy will take a swift temporary hit in the second quarter, but should recover reasonably swiftly, and the current swoon is creating attractive entry and upgrade options. We are not sellers, but we're holding positions in a diversified, balanced fashion, unlike some of our peers who suggest more extreme positioning and measured. I would like to offer key talking points. So the key talking points are as follows. First, as you know, we have expected and embraced a market pullback or pause. And we're sorry to see that it's being caused by a global health scare issue. But given the robust 2019 returns and the strong initial start to 2020, we thought a pause was necessary to reset and refresh and remove some of the excess. And frankly, it could have been caused by any number of wall of worry headline issues, such as the political campaign underway, geopolitical tensions that are out there, fallout from the impeachment circus, etc. But it just so happened that the coronavirus data really has taken us here at this time. This correction that is underway should, in our view, set the stage for a further advance later in the year. So from that standpoint, it's healthy. There's a big difference, and this is the second point, between conditions surrounding normal and even deep and swift corrections versus conditions that precede bull market tops. The former temporary corrections are caused by temporary supply shocks or negative sentiment that's temporary versus bull market tops that are preceded by imploding earnings, a surge in unemployment, massive dislocations in the credit markets, none of which we're seeing at present. Now, we're aware that the energy market, because oil prices have come in as the Saudi Arabia and Russia are arguing a bit, we think that also is temporary, but you're seeing spreads move out there, but not in the rest of the credit world. So that's quite contained, and still the credit markets are healthy. We're heartened, and this is the third point, that the U.S. economy was strengthening going into this coronavirus scare. To wit, the blowout 273,000 new jobs created in February of this year and the significant positive revisions to earlier months. This complemented the healthy or re-accelerating figures for consumer confidence, retail sales, manufacturing and service activity data, and so on and so forth. In fact, the Atlanta Federal Reserve revised their Q1 GDP growth forecast up to 3.1%, so north of a 3% handle. Now, we realize this is rear view mirror data, if you will, but it's important to know and to understand that we have been entering this coronavirus scare with strength in the economy, not a flagging economy. And that's pretty important. In terms of going forward, we maintain our expectations for positive GDP growth in the U.S. this year. The path will be a bit different, however, with weakness in late Q1 and in Q2, but we look for reacceleration in the back half of this year. And this captures the fact that this is a temporary lull in the economy that we'll see in our view. There's a big difference between a deceleration in the economy caused by self-induced quarantines in China and self-induced reduction in activity in the United States and elsewhere versus an implosion in demand caused by massive excess that builds up over multiple quarters and years, dislocations in the economy, and failing bank institutions. This is not of the latter variety. In supply shocks like this, it does spill over into demand in temporary and swift fashion, much like what happens in tornadoes or earthquakes. But as lifestyles normalize from the shock, demand resurfaces in swift fashion, often referred to as this V-shaped or U-shaped recovery that we still think is very likely. With interest rates this low, mortgage activity should be robust when things begin to normalize, and oil price declines can be very stimulative for U.S. consumers. These are tailwinds that we believe are underappreciated and will assist in a swifter recovery. So what to do? I think we need to really look and talk about the coronavirus stats themselves and make sure we understand them. An unappreciated fact is that new cases in China, where all of this emanated, are now virtually zero. New cases totaled roughly 40 over the weekend. And in South Korea, they fell swiftly and significantly to less than 250 new cases. So this gives us support in the view that this is being contained and managed very well in China, which is the template. And that rather than this being a multi-quarter issue, they've done this within several months, which is very important. And it's the template for the rest of the world. Now, many people criticize and say, yes, but they quarantined 60 million people. And they handled this, in a much more restrictive fashion they'll be able to do in the United States. There are pros and cons of the way each country will handle this. But in the United States, it's also true, and this is a pro for this country, that we're 5 times as wealthy as the Chinese and have much more access to healthcare. And we're much less densely populated. In Wuhan, where this started in China, they have the population roughly of Chicago on 1/4 of the real estate. So we don't have that density that we're challenged with. So we don't need the quarantine kind of guidelines that they implemented, and we can handle it differently. But we do believe that the path of being able to mitigate this and manage it will be not that long, lingering issue, but can be done in a very reasonable amount of time. The other thing that we just want to make sure that everyone understands is that roughly 80% of the people that get this are fine. Drink some Gatorade, sleep, and take care of yourself for several weeks, and you're fine. So it's folks that are older, that have pre-existing conditions that really need to be concerned. But the bulk of the population handles this extremely well. And in fact, the mortality rate, while the published figures are somewhere around 2%, I think that we don't, and certainly have not in the United States, taken a look at what they call that denominator. The actual number of people that are infected is probably far larger than we appreciate to this point in time. So once we realize more are infected, and that ratio of who are dying versus that larger denominator is more likely to be similar to the ratio in flu. And so I think mortality rates and the significance of this is much more flu-like in nature than is appreciated at present. So with all this information, what is one to do? We think balance, diversification, and poise is the key. We've been implementing and will continue to blend offense and defense. And I say the one phrase that we would really suggest that folks think about is hold your ground. Don't mistake activity for progress. We are continuing to hold our positions in this balanced portfolio and upgrading where we can. There are particularly a number of opportunities that have been building, with 78% of the S&P 500 stocks having yields greater than the 10-year Treasury. A number of higher yielding, high-quality stocks trading at very attractive prices. So that high-quality focus gives you some really good income opportunities with price upside, we think. It's a little premature to just buy on the dips, but we do think that we are closer to a bottom and that we can practice this hold your ground and in measured fashion upgrade and add to equity positions over time. So I'll leave it there. I started out this year by saying, say no to negativity. Don't jump to worst case outcomes. That certainly has paid off when it's come to issues about, is the Fed going to make a major policy mistake? Will we get through the trade rhetoric? Is Brexit the end of the world? And repeatedly, when folks have said this time is different, it's shown that actually not jumping to worst case outcomes has been where you should fall. And we would say that type of thought, staying focused to the facts, is the critical thing at this point in time. Appreciate your time and your attention. We'll continue to keep you updated. Thanks.